Hey there, thanks for taking a minute to watch this video. In this video, we're going to be going over taxes and as far as what the economic factors are that may be driving taxes up, down, or having them stay the same. And we'll be discussing what you feel like may be the impact of taxes as it relates to your building wealth and setting up a nest egg or a retirement account, and just taxes in general and understanding the implications of those. And so the question is, do you think that taxes are going to go up? Are they going to go down? Or are they going to stay the same? Well, let's talk a little bit about the history of taxation, shall we? So back in the day, our highest, well, let's start off with a story. So I'm sure that a lot of you are familiar with Ronald Reagan. Now, he was the president of the United States at one time, but before that, he was actually an actor. And he kind of was famous for only doing 2 movies a year. Now, this is because Ronald Reagan was smart and he understood the tax code. And at that time, the high-income earners were taxed at a tax rate of, gotta set some of these markers down. The federal tax rate at its highest point was 94%. Pretty astounding. That's not considering state taxes, that's not considering other taxes. This is just the federal income tax rate. At its highest point, it was taxed at 94%. And this was around the time that Ronald Reagan was making movies. And so if to take him in that situation and put it into that type of tax bracket, so he would make about $100,000 per movie back in the day, which that was a lot of money back in the day. I mean, it still is a lot of money, but it's even more so then. And so if he was making $100,000 per movie, and he would do about 2 movies per year, and then he would stop working, the reason why he did that is because after about $200,000, he would get taxed at 94%. And so it didn't make a whole lot of sense for him to work extra hard to earn more money, because he knew that on a federal level, the IRS was going to take 94% of that. And that's not even factoring in state taxes or other taxes. And so what was he actually going to see? Like, it could very easily get rid of all of his income depending on how the state taxes work. And so 94% is the highest that they've ever been. So where are our taxes right now? Well, our highest marginal tax rate at the time that I'm recording this video is 39.6%. So we were up here, now our taxes are down here to where historically it's actually a low point. I mean, even as recently as the 70s, federal tax rates on high income earners were in the 70% range. And so we're at 39.6%, which is actually some of the lowest taxes that they've ever been. And so it may not feel like it, but it's relatively low. So let's talk about the details of where do we see taxes going. Are they going to go up? Are they going to go down? Are they going to stay the same? What are we going to do? To understand some of the larger economic pictures, let's talk about the financial health of the United States government. So you've probably seen this figure on the news to where we are about 20 trillion in debt. Now, we oftentimes throw this number around, 20 trillion in debt, and you see people, news anchors and people on TV who just throw the term trillion and million and billion and use them in the same sentence as if they're not that much different. They are worlds apart. And to help illustrate that, I'm going to read something off here real quick. Let me pull it up on the computer, and I can tell you the difference between million versus billion versus trillion. Now, if we were to compare this to seconds, this is how it would work. So 1,000,000 seconds is 12 days, so not that long ago. 1 billion seconds is 31 years. 1 trillion seconds is 31,688 years. So talking about, hopefully that gives you some scope of 1,000,000 seconds, 12 days, 1 billion seconds is 31 years, 1 trillion seconds is 31,688 years. So that's longer than we have like recorded history, right? Is 31,000 years. So we've got 20 trillion in debt, right? So that you can do the math on that one as far as how many years that would be. But we're 20 trillion in debt. And you've probably heard that term on the news. So that's a significant figure. But the number that you never hear about on the news, I'll be a little bit on the conservative side, is what we call unfunded liabilities. Now, liabilities is a term that we use a lot in the property and casualty insurance world, and it's oftentimes a term that just kind of flies over people's heads where they don't think about what it actually means. What is a liability? It is something that is a risk. It's something that you may be, like in the auto insurance sense, if you have certain liability limits, it's either how much you're going to take on of risk, or how much the life insurance or the insurance company is going to take on in risk, that I would define this as financial responsibility in this context. So we have unfunded financial responsibilities, and this number should blow your mind. If it doesn't, then we need to talk. But we have 105 trillion $105 trillion in unfunded liabilities. So examples of what we mean by unfunded liabilities. These are government programs, and I'm not saying that these are bad government programs, but these are things like Medicare, Medicaid, defense spending, so on and so forth. That we're already 20 trillion in the hole, meaning that our GDP, or think about GDP like the revenue for the United States of America, we haven't been able to pay our bills, and so over the past few decades, this 20 trillion has been created, this 20 trillion of debt through unsound financial practices. If you want a great book to learn a little bit more about how this works, it's called Come Back America by David Walker. He was the Comptroller General, basically the accountant for the United States. And so it's something to understand a little bit about how these numbers work and how it impacts. So we've got 20 trillion in debt, and then another 105 trillion of unfunded liabilities, financial promises that we've made saying, yeah, sure, we'll pay for this in the future, and we don't even have the funds to pay our bills right now. And so how does that make sense? So in talking about government, I won't get into my political beliefs, but where does the government get its money? Does the government create money? Do they do something that just spontaneously creates money? If you're talking in a literal sense, then yeah, the government's usually in control of actually printing dollars. And but if those dollars don't really have the worth backed behind that, they can print all the money they want, but those dollars could become worthless in an inflationary sense. But where does the government actually get its money? Is it some sort of entity that creates money, that creates value? No. The government takes money from you and I in the form of taxes to provide different services. And so the government doesn't create money, but they simply tax and take that money out of our paychecks or out of our businesses and things of the sort. And so if they're in the hole, where are they going to get the money from? If they're 20 trillion in the hole, got another 105 trillion of unfunded liabilities, we can only go so long before this starts catching up with us. Politicians for the past few decades have been kicking the can down the road, so to speak, and postponing, raising taxes so that this politician or that politician can get elected. That there's been very few politicians in recent history who have had the fortitude to actually say, you know what, we have to increase taxes. And it's not a fun thing to think about, but it's something that is going to happen. Like, mathematically speaking, there's two ways that you could do it. Either one, the government could rein in their spending like crazy. They could just start cutting government agencies and the funding and the dollars that are going out from the government, so they could just rein that in and they could cut down on their spending in a huge way. What do you think the likelihood of that would be? Let's say that they cut something like Medicare, or let's say that we cut defense spending as a whole. What would happen? Well, that would cause like a public outcry, and politicians would get kicked out of office, and most politicians like their job of being career politicians, and so they're not going to rock the boat too much. And that's what's got us into this financial predicament, is that politicians making financial promises that we don't have the funds for, that they've passed laws that most of America doesn't even know exist, to where the United States government isn't required to keep a budget right now. They got rid of budgeting requirements, and they just started printing money like crazy during George W. Bush's stay as president. And so this is a crazy thing to think about. And when our debt reaches about the $50 million mark, then all of our revenue for the United States, all of our GDP will just go towards paying interest on the debt. It's not even going to cut it when it comes to paying the principal down on the debt. It's only going to be paying the interest on the debt. So this is the state of our government right now. It should be concerning to you. So we were up here at 94%, so the IRS has gone there before. Now we're right here at a historical low point. So where do you think taxes are going to be in light of this new information that you have? Where do you think that taxes are going to go? My bet is that taxes are going to be going up from here. So they dropped. We'll draw that in green because we kind of like that when we get a tax decrease. For the past little while, they've been kind of staying level. So we'll draw that in blue. But where are taxes likely to go? Well, the taxes are likely to go back up. Now, there's some economists who predict that tax rates are going to have to double just to keep our country out of bankruptcy. And so one of the biggest sitting ducks for the IRS to come and start taxing is people's retirement accounts. Because again, the government gets their money from the people. And so retirement accounts are a sitting duck. So talking about, as we talked about in the previous video, if you haven't watched that yet, by the way, go back and watch the previous video. But talking about how most Americans are postponing paying their taxes, they're kicking the can down the road, and they're thinking, oh yeah, we're going to be in a similar tax bracket or even a lower tax bracket. They simply just don't understand how that works, is that most of the time you lose out on your deductions and your credit, your tax credits that you get during your working years. Some of the most significant tax credits are going to be, some of the personal exemptions that you get, the interest that you get a write-off on your home, if you have kids, things like that. In your work, once your kids have moved out of the house, you've got your home paid off, maybe by the time retirement comes around, that you're not going to have those tax benefits. But also, in light of this new information, taxes are probably going to be going up. And so if you're postponing paying taxes like previous generations have done, back in the 70s when tax rates were in the 70% range, or even up here back in the 50s and 40s, 50s, 60s, that 94% range, it made sense to postpone taxes. That's why some of these financial vehicles were created, such as an IRA, is to put off paying taxes to a later date when taxes were hopefully going to be lower. Well, taxes are lower, and now they're at an unsustainable rate. And so where are taxes going? They're going to have to go back up. That mathematically speaking, they're going to have to go back up, or the government's going to have to rein in spending in a huge way. So understanding how this works is huge. So your retirement account is a sitting duck for the IRS to come in and get their hands on it, because you literally have no control over. If you haven't paid taxes yet, sorry. It's kind of like if I need something, let's say that I need a new pair of shoes, which I do. I have a habit of walking on the outsides of my feet, and so I round down the outsides of my shoes. So if I need a new pair of shoes and I find the ones that I like, I find the ones that I need, and I can buy them on sale right now for, say, $100, but in 2 weeks from now, they're going to go off sale and they're going to cost $200. What would be the financial prudent decision for me to do? It'd be to buy them while they're on sale, right? So taxes right now are on sale. Take advantage of them while they're on sale and put money into that. If you remember the last video, put money into that Tax Never Again account as much as you possibly can. Now, that's not the only account. Again, that principle that we learned from children's storybooks is never put your eggs all in one basket, right? But that's where I would be carrying most of my nest egg if I were you, and in fact, that's what I'm doing. I put my money where my mouth is. So I put that in that Tax Never Again bucket once we understand how this is going to work out. The last argument, and then we'll let you go on this video, is to think about, so I grew up on a farm. Now, if I had the option to pay taxes on the seed or on the harvest, what would be financially prudent for me to do? It would be to pay taxes on the seed, right? Not to pay taxes on the harvest, because a seed can multiply. A seed can, create, a plant or a flower, and then that drops more seeds, and it's just this multiplying effect. So if I can say, hey, I'm going to pay taxes on the seed, not the harvest, I'm going to be in a much better position, and my taxes are ultimately going to be lower. if we put it and structure things the right way. So I'll leave you with that. Thanks for watching this video. We'll be talking a little bit more about permanent life insurance and just general financial information as it relates to taxes and investments and things of the sort. So thanks for watching. We'll catch you on the next video.